This is two corporate financial statements. On this side we've got the Apple computer, the iMac, the iPod, the iPhone, the iTunes, the iTV, everything. And then you got Blockbuster Video, who is a victim of obsolescence risk. So let's see how this plays out and how looking at a corporate financial statement, doing some corporate fundamental analysis can help us find value or identify risk or stability as we go to purchase stocks. So Apple Computers, $86 billion in assets at the end of 2010. Now, why am I doing this a while back? So you can see some growth. Watch this. $86 billion. Now, that represents all the stuff they have that they can use to make money. Now, it also costs them some money to make some money, but generating that income from the assets, $26 billion the last quarter. That's an unbelievable amount of revenue. Of course, it costs them some money. They got to pay employees too, right? They have expenses as well. You have the assets produce the money, but they got to spend some to make that cash too. So $21 billion to make all that stuff. That's $6 billion though in a quarter. Who only needs a small portion of that to keep them happy? $6 billion, I'd take it. So that's really cool. Now, another thing they did is, remember how we talked about, you know, an example would be a corporate bond, and they have debt they take on because they want to grow fast, right? They want to grow really, really fast. And sure, $6 billion isn't bad, but you could grow a lot faster if you borrowed 32. So they have $32 billion in liabilities, and some of that's just for growth, some of it's for other things. But that's an interesting thing because, you know, there are some gurus who I like. They're entertaining. I'm not going to mention any names like, you know, like Susie Orman and Dave Ramsey. I'm not going to mention names like that, who always say, debt is the devil and don't go into debt and debt's bad and cut up your credit cards and don't go into debt and wah, wah, wah. Listen, the United States is abusing their debt. Apple is using their debt. Don't abuse it, use it. In fact, the reason Apple and some of these companies grow so fast is why? They're using debt to grow. They're using debt. More powerful to just leverage the money than it is to pay things out of earnings. You will not grow fast. So I don't care if I want to grow stock like Apple and they have some debt, as long as they're using the debt to grow and not to pay for liabilities. As long as their programs are solvent, they're looking like they're solvent to me with $6 billion coming in each quarter. Whatever they're doing is working. Why don't they pay off all the debt? Well, then they'd only have $50 million, right? I mean, they got a net worth of $54 billion. They're only going to have $54 billion in assets, and you cannot generate $26 billion out of $54 billion in assets. That's why they're using some leverage, okay? So they're doing pretty well. Blockbuster, $1.1 billion, so not very big. Apple's biggest market cap, though, of all the U.S. companies. They generated $736 million. So darn near. Isn't that interesting? They're generating almost as much, you know, revenue here as they have assets. Problem is they spent a lot more to get it. Ouch. Wait a minute, they only brought in $736 million, but they spent $799. Well, yeah, they got employees. They got all these, you know, all these Blockbuster videos you see. They take up a lot of space, and there's rent and leases to pay and all kinds of stuff, employees and fees and franchise stuff to pay. So a lot of stuff going out there. $53 million. How long your business going to last? They're insolvent. So what is the pattern? See, that's why I want to show you Q4 of 2010. What's the pattern? Insolvent, then what? Then what? Do you remember? Delinquent or default, and then bankruptcy. So whenever you see a company start to go delinquent, what is likely to happen? Policy plus demographics equals the future. Well, think about this. I go out, I'm a big Apple fan. I'm on an Apple right now. I don't know if you are. You're probably on some computer, right? And so I buy Apple TV. Haven't been to Blockbuster since I bought my Apple TV. I'm not going to go stand in line and get a DVD. That's insane. I'm downloading my movies. I'm not going to pay a late fee from Blockbuster because I forgot to. It's a pain in the butt to drop that off. I just download a rental from Apple on iTunes for 3 days or however long, and boom, I'm set. I download it. I got a month to watch it. Once I watch it, I don't need it anymore. I don't need to take it back. So that's called obsolescence risk. When we do the risk one, we'll revisit this. But Blockbuster is a victim of obsolescence risk. Apple TV's chewing them up. Netflix chewing them up. I don't want to go to the video store. Going to the video stores, oh, DVDs, nah, we're downloading things. That's the new way. DVD, hey buddy, obsolescence risk down here in the corner. Don't you know what this is about? Liabilities, 1.16 billion. That's about a $400 million difference right there. And so they're in the hole. So they don't have any equity. These guys got 54 billion in equity. These guys got nothing. They're minus. So this is called insolvent, and it leads to delinquency. Now, could they have turned it around? Yes. Could these guys falter? Yes. But we're not talking about what's going to happen. We're talking about not what could happen. We're talking about what is most likely to happen. We don't have a crystal ball, but we have fundamental analysis. What's interesting is some people don't look at value. They only look at price. And they don't understand the difference between price and value. It's one of the dangers of consumers trying to be investors. E-quadrant guys trying to act like I-quadrant guys. Check this out. At the end of 2010, Apple's $300. Well, now they're pushing $4. Why? Value. They're earning money. People want to buy things. They're earning money. 6 cents. Now, a lot of people were buying this. Trading means they were buyers and sellers. So some people saw this trying to get rid of it. Some people just saw the price. Said, oh, it's Blockbuster. Let's buy him. It's cheap. What do I have to lose? Well, I'll tell you, you got to lose all your money, all 6 cents, the whole thing. So Blockbuster has since this time gone bankrupt. That's a great lesson. The penny stock guy, it's usually a penny because of something like this, or because they haven't made any money, or it's all potential, or you're hoping for a turnaround and you're gambling, you're going with luck. You're not getting any value back, only potential, only hope. I'd rather go with what's likely. So you got to make your own decisions. I can't tell you what to do, but you can learn what a corporate fundamental analysis is. Let's talk more about it. Let's talk about value. Let's talk about what we get. So part of what we do with fundamental analysis is we try to figure out the strength of an entity and how valuable it is. So we have this term here called valuation. In other words, how are we going to put a value on something? Well, we put a price on things by supply and demand. That's how we price a company. I mean, when you're going to buy something, you're competing with everybody else that wants it too. So based on how many people want it, they're going to be able to charge more. That's called supply and demand. And that's price. That's what you pay. You're paying what what the supply and demand is. You're competing with other people. We study this with something called technical analysis in our next lesson next time. But right now, we're on value, what people receive. And the problem with a lot of people who want to be investors is they're so caught up with price that they don't understand value. They think the Walmart has low prices. But it might not be the best value. I mean, you buy the big pen and it costs you a few cents, but then it leaks all over your nice shirt. Where the Mont Blanc, baby, that's looking good. And not only that, people know you're in business. You're serious. You've got the Mont Blanc going. So earnings is a big deal. Well, how much are you going to pay for earnings? I mean, picture this. If what I receive when I buy stock is a share of the earnings, picture it as a box that spits out money, or a machine that spits out money. How much money does it spit out? Well, that's going to determine what people are going to pay is going to be determined by how much money it makes, right? So usually the more money it makes, the more they'll pay for the stock. Of course, they issue different types of stock and different numbers of shares. Why is one worth $300 a share? Do they earn that much more? Not necessarily. So we need to learn a few things here about earnings. And we do that by looking at the income statement, the balance sheet, and some relationships between some of this stuff. So let's check it out. I'm going to teach my kid about earnings the same way you're probably teaching yours. Okay? You can learn it in a book. You can learn it by having Daddy teach you. But the best way to learn about earnings is let's go earn something. Let's start a business. And so just like you, we got to do the lemonade stand, right? So introducing Tanner Brothers Ice Cold Lemonade. There it is. Soon to be world famous, I'm sure. Owner number 1, 5 years old. Owner number 2, only 3 years old. Do they know how to add? A little bit. They know how to multiply? Not really. Do they know how to divide and do ratios? Not even close. They're only 5 and 3, and they got their dad's genetics, so let's hope they do better than I did. But Dad was a venture capitalist. We got a cash box and put some Federal Reserve notes, cash inside. And they said, oh, this is our cash. This is, no, it isn't. We're going to the store. And they had to take the cash out, 20 of them, and buy lemons and sugar. Probably have to pay some taxes too. Those were the costs. Then they had their inventory was set, and they hired an intern because they couldn't afford an employee yet, so they went cheap, hired an intern, called their mom, but she was sharp. High quality cookies, high quality lemonade here. And so they started selling, man. Got to go out and sell. Number one skill of an entrepreneur, raising capital, venture capitalists, and then selling inventory. Number one skill of an entrepreneur, raising capital, selling inventory, baby. And so they had some revenue that they understood, some costs they understood, and they saw the cash box got bigger again. So they're working on it. But you and I can do a little bit of math here. That's $30 in earnings. So on a Saturday, we know we can make $30, and that's what we know we can do. So that's cool. It's about 60 glasses of lemonade. That's awesome. Now, this pizza is owned by two people, and it's cut in 100 different slices. So if we have one pizza and it's cut into 100 slices, and each of them have half the pizza, that means one guy gets 50 slices, the other guy gets 50 slices. Another word for slices is we're going to share and share alike. How many shares do you have? 50. How many shares do you have? 50. Senior partner has the tiebreaker and the voting rights in the LLC. Ha! So here's their $30 per share. They have 100 shares. So what do we have to do? We have to divide or split, right? We have to split that $30 up 100 ways. We have to split that $30 up 100 ways. So if that $30 was the pizza, and we cut the pizza in 100 different slices, we split, or another word is what? To divide. So we take 30 and we divide it by 100, or in other words, we split it in 100 pieces. We get 30 cents. Each piece of the pizza represents 30 cents here. So that's earnings per share. So here's the question. If you're a bystander and they're willing to share this company with you, in other words, they're willing to let you buy some of these shares, you know each share you get is going to make you 30 cents. That means every Saturday you'll make 30 cents for every share you buy in from this company, right? Every Saturday you make 30 cents. So how much will you pay to make 30 cents? You're a stock owner. You don't have to do any of the work. You're a stock owner. You simply buy in this company. It's 30 cents to you every Saturday, it looks like. That's pretty cool, isn't it? So we got to figure out how much we're going to pay if we're going to have those earnings coming our way. There's only 100 shares. A lot of people are going to want to be buy into this baby. A lot of people. So we need a price earnings ratio, and I hate that word ratio because that means more fractions. So what did I say? Debt to GDP ratio. It's just relationship. So this is just saying, hey, what's the relationship between the price of this stock and the earnings that the company produces? What is the relationship between how much people want to pay and the earnings that they receive? Well, our earnings for each share were 30 cents. So how much are investors willing to pay for every dollar this business is earning? Let's take a look at it. We got the stock price here, which is $3, it looks like. We got the earnings per share, right, which is 30 cents. And so if we say we take the stock price, right, and we see they're willing to pay $3 to get 30 cents, well, that's a PE ratio of 10. So a PE ratio of 10 simply means someone's going to pay $10, right, for every dollar that the company earns. That makes sense right now, right? 30 cents. Well, if 30 cents gets you 3, so $1, well, it's going to be about 10. So that makes sense, right? That makes total complete sense. Not dollars, but cents. So price earnings ratio here is 10. So that already tells me, do I want a high? Give you a little quiz here. Do I want a price earnings ratio that's high or low? I want one that's low, right? Because right here they're paying $10 for $1 of earnings. I'd rather pay $5 for $1 of earnings, or $2 for $1 earnings. But if you're paying $100 for $1 earnings, well, that's called a multiple. You're paying 100 multiple. So that's another word for that, is a multiple. How many dollars right here? So price earnings ratio, really, really easy actually, right? You look at the price earnings ratio, and that simply means I'm going to pay what? I'm going to pay $10 to receive $1 of the company earnings. And that's what it is, $10 for $1 of earnings. If the price earnings ratio is 12, what would that mean? That means I'm paying $12 for $1 of earnings. If the price earnings ratio was 100, what does that mean? That means I'm paying $100 for a dollar of earnings. And that's how that works. People say, well, do people really pay that much? Yes, they do. Why? Well, one reason, they might think it has potential to make more money. Think about this. If I buy the stock for $3 and then all of a sudden they start selling more lemonade and they can sell $100 worth of lemonade, well, that'd be really, really cool because I only had to pay $3 for that. So that's why they do it, for potential. In the dot-com boom, you had multiples of 200. People paying $200 for lousy earnings. In fact, they had PEs that were undefined, divided by 0. People were paying $10 for 0 earnings. Why? Hoping someday they would. Hoping someday they would. So this starts having to tell us the value. Yeah, I'm paying $3. Well, price doesn't tell me anything. Oh, you're getting 30 cents of earnings. Okay, now I see some value. Now I see what I'm getting. So a person who invests without seeing the price-earnings ratio has no concept of value. Oh, I'm paying $300 a share for Apple. Okay, what do you get for that? How much of the earnings do you get for that? Oh, I'm paying $35, $40 for P&G. Oh, what do you get for that? So people that buy stock without a knowledge of fundamental analysis and price-earnings ratio, yeah, they know the price they're paying, but they don't know the value they're getting. Remember this guy named Warren Buffett? He's called a value investor. I'll bet you he knows the PE ratio every time he buys something. Market capitalization. What is the total company worth? Well, if you want to take this company over and you want to buy the whole thing, the share price is $3. There's 100 shares, so what do you have to pay? $300. And why don't they just use English? I don't know. They have to call it market capitalization. In other words, how much capital would you have to come to buy this, right, and corner it? So that is simply the share price and the total number of shares, right, times the total number of shares gives you a market cap. And since this is only $300 here, market capitalization of $300, this would be categorized as a nano cap. Nano meaning small, as in nanometer, as in very, very nanotechnology, tiny nano. Apple's not nano though. Check out Apple. Look at this. 342.8 billion, $340 billion. They just passed ExxonMobil. And Mark Gongloff here from the Wall Street Journal says, we're looking up to Apple now. It might be for good. Apple, largest public company in America, just passed ExxonMobil. And so the oil company is, what, 339, Apple's 342. They may stay there. Why do we care? Well, large caps are usually, we're talking about companies that are worth 10 billion. In other words, if you bought all of their stock, bought every share at today's price, it's going to cost you more than $10 billion to buy a large cap company. The S&P 500, 500 large cap companies. Mid cap, 2 to 10 billion. Small cap, 300 million. Okay, and then on down. So usually, why do I tell you this? Well, you might have someone pitch you a mutual fund and say, oh, we're filled with large cap companies. Or someone pitches you a mutual fund. You say, well, we got mid cap companies. Someone pitch you a small cap mutual fund. Oh, we got small cap companies. Well, what's the difference? What's the difference? Well, here's the difference in theory. A large cap company like Apple, you know, the idea is they're probably well established, right? So if you had all these large cap companies, a lot of power here, you know, hey, one location closes down, yeah, they got plenty of others. They take a hit, break a pipe in the Gulf like British Petroleum. What does BP stand for? Broken pipe. No, it stands for British Petroleum. You break a pipe in the Gulf, hey, we're large cap, man. We got all kinds of money. We're well established. Our balance sheet big. But maybe not as much growth potential, right? I mean, Procter & Gamble, they've grown a lot. I mean, they're gonna start selling more toothpaste to us all. I don't know, more Charmin, you know, more toilet paper. They don't make really interesting stuff, just kind of regular needed stuff. You know, a nano cap company though. What if you invested in Steve Jobs when he was at this stage, you know, building circuit boards in his garage? Boy, you'd have taken advantage of some huge growth, right? So small caps have potential for growth, but greater risk because they don't have as much, you know, they're not as well established. So when someone says, I'm going to sell you a large cap fund, well, the theory is that you probably won't have as much return, probably not much growth potential, probably not as much return, but you probably not take as much risk either. Someone sell you a small cap mutual fund, well, big time growth. You know, they got room to grow. It could blow up, but it could also blow out. You know, so it could do well or it could do poorly. So that's kind of the idea between large cap, mid cap, and small cap. To do that, you have to know, you know, kind of their earnings, and you kind of got to know the stock, or the stock price. You got to know the number of shares to figure that out, right? Earnings growth. We always like to see growth. Now look at these guys. ABC, they had some earnings today. Look at that. Above zero, they made money. XYZ, they didn't make money today. They lost money. So which one do we want to buy? And everyone says, hey, that's a no-brainer, Andy. I'm going with ABC. I want the one with earnings. Well, guess what? What if I do that? Oh, maybe I don't want that anymore. Maybe I want this one. Why? Because I'm worried about this trend here, and I like this trend here. See, these guys haven't made any money yet, but this looks like Blockbuster Video over here, right? They're still in business, but they're getting less and less earnings every single month. Obsolescence risk. I don't like where they're headed. This guy, this is Netflix. You know, good idea, but had to go into debt. You know, if you're going to sell this thing nationwide, you don't have any customers, you better raise some capital. But they're gaining more and more customers. We like where they're headed, and pretty soon, what do they have? They'll have positive earnings, and that's when the stock really starts going up. So we like the trend. We're looking at growth. We're looking at trend, not just where they are today. See, that's where they are today, but do it in the context of trend. So that tells me something about valuable. See, value is what I'm paying for. So if I'm paying for price, or if I'm paying for earnings rather, you know, let's make a decent looking E here. If I'm paying for earnings, that's part of value. But what about growth? Is one company that's growing more valuable than a company that's not? Even though these guys have earnings, these guys have what? They have growth. These guys aren't growing. So which company is more valuable? Well, we got to think about that. We got to think that through. So what we're going to do is we're going to figure them all in. Let's consider everything. Let's say, all right, I'm going to look at the price I'm paying as one factor. I'm going to look at the earnings I'm getting as another factor. I'm also going to look at the growth of the company as another factor. Well, I knew that Tanner Brothers Lemonade had a PE ratio of 10, which means I'm paying what? $10 in price for $1 of earnings, right? Paying a PE of 10. But I also see they've had 10% growth. So what is the relationship? Remember that ratio, right? What is the relationship between their growth and their PEG ratio, their price earnings? Well, here, if they had 10% growth, they have PE, they got a PEG of 1, which I will say, that's not too bad. How do I know if that's good or not? Maybe I compare it to other lemonade stands. I probably shouldn't compare it to a computer business because it's not the same idea. Or maybe I should. Or maybe I shouldn't. What I should probably do is say, hey, what is the average growth of a company? Because all I'm paying for is earnings if I don't look at industry. I say, what's the average growth of the company? And what's the average earnings? And I should be growing better than average, and I should be getting earnings that are higher than average. And if I do that, I'm looking at value. And I'm therefore probably called a value investor. So here's a PEG of 1. Well, look at this. If I was paying $20 for $1 of earnings, okay, let's break this down with maybe a marker here. If I'm paying $20 here, and I'm only getting $1 of earnings, that's not very valuable, and I'm only growing 10%, so that's going to have a PEG of 2. Overvalued. Because see, I can go here, and I only have to pay $10 here to get $1 of earnings, and I have the same 10% growth. It's pretty good value. Of course, if I can get $10 in price to get that $1 of earnings, if I'm only paying $10 for $1 of earnings, but they're growing at 20%, shoot, that's a killer value. That's way undervalued. They should be charging more for that. So this one right here, heck of a value for the price you're paying. You're not only getting $1 of earnings here, but you're getting 20% growth out of your company. Pretty impressive. Of course, if you start getting into 0.3 and maybe 0.2, you got to start asking yourself some questions. That's too good to be true. Why is their PEG so low? That's like buying a Ferrari for $2. That doesn't make any sense. So how do we look at this? Well, we look at this. We want to make sure less than 5. Too good to be true. Thought I better put that in there. So I probably look at the historical performance of the company over the last 5 years, see if the peg's growing or see if it's shrinking, see which direction it's going. And then I'm going to, like I say, compare apples to apples. How's it doing within the sector or of its group? Should I expect that much growth? I mean, hey, if I'm looking at a P&G, should I expect them to grow like a technology company? I probably shouldn't expect that, right? And then I consider both the future earnings potential and the current. What's the future? Oh, demographics plus policy equals the future. Looks like we got a lot of young folks. We got a lot of people who are interested in having iPads and iPhones. It's part of the culture, and they certainly like to text. That's demographics. Apple's policy is to come out with a new iPhone every single year, almost. So policy, right, plus demographics equals the future. If you're selling 8-track tapes, you might have obsolescence risk. I don't think my teenagers, or my nephew's a teenager, I don't think they know what those are. So that's price, earnings, and growth. Do you like this stuff? I think it's way cool. When we work on wealth building, we just talked about value. We work on wealth building. We want to buy assets. So we get up in the morning, what can I buy today? You're in buying mode. Excuse me. You're in buying mode. Every day you're trying to buy business, real estate. You're trying to get rid of your cash and buy something valuable. What is cash? It doesn't do anything. It doesn't generate anything. We want to trade in cash for a business or real estate or stocks. So there's vocabulary, and I've been really talking, with you a lot about vocabulary. So I might ask you a question: what's the difference between an S corp, limited partnership, or a limited liability company, and what fits best for you? Those are things you want to know if you're in business, real estate. Let's do a 1031 exchange. How would that help you in your taxes this year? Would it? You got to know what that is. Okay, so we've been working on trying to find great stocks, right? We're looking around at all these different companies, bird's eye view. We say, okay, what's a PEG? What does a PE or market cap mean, and how does it relate to value? So in other words, vocabulary helps us, the knowledge helps us translate information into meaning. If I don't have this knowledge, not have a vocabulary, when I watch CNBC, read a periodical, talk with my advisors, or go to purchase something, the information has no meaning to me. So part of what we're hoping to do is help you become aware, move along the education continuum towards proficiency, and it just starts with little bite-sized pieces like this, moving along at a really good pace. Don't want to wait forever to start making money. You want to make a good pace, and that's what this is for. Commodities has vocabulary. Dow to gold ratio. It helps us see where things are without being clouded by inflation and currency. So important stuff that we're learning here. So each asset class has this vocabulary. So here's a bunch of words, a bunch of information, a bunch of vocabulary. Let's do a wealth building activity, and let's see if we can put some meaning, okay, to these numbers and to this vocabulary. And you can practice by comparing several different stocks, comparing their value and what they do, one to another. And if you have some stocks, you can do this. You can use whatever free stuff, Yahoo Finance, or I use software to trade stock, but you could do this. Google Finance, Yahoo Finance, they'll find stuff. So here I've just kind of gone out on the internet and found a financial site, and I'm going to use Apple for mine, and you can put in something you own. So here we got Apple, and we can get quotes on that. But if you look all the way down here at the bottom, I've got this down here. What does it say here? It says what? Key statistics. So I'm going to circle that. Key statistics down here in the bottom left. And those key statistics are simply going to tell me this stuff here. It brings this up. And I've put the income statement on here just so we can refer to what part of the financial statement this is kind of talking about. So let's go. First up, we got market cap. Hey, you guys know what that is. That's if you bought the whole thing out. So if Apple's, $300 something dollars a share, you know how many shares they've split that thing up into. Pretty amazing. And so the market cap is just the total dollar value of the company. What would it take to buy the whole thing? Now, enterprise value, remember we're talking about valuation here. These are all valuation measures. These are all things we use to find out the value. So why would market cap give me some value here? Well, it tells me that this is large cap, which means they're pretty established. I might find more what? More value in having an established company, right? More value. What is the enterprise value? Well, that's kind of like market cap. What it does, it takes the value of the whole company, but it also includes what? The cash they have, right? Includes their assets, and it includes their liabilities. So it kind of tells us, if we just don't look at the price of the company, but if we actually owned it, we'd have some cash and some debt to deal with. Okay, trailing PE. Now trailing means yesterday, right? Trailing behind. What is this TTM? I'll bet it stands for trailing 12 months. What do you think? So over the last 12 months, right, what have their earnings been? And then intraday, in other words, today's prices, moving intraday, what's been the average price today? So if I look at the last 12 months of earnings, and I look at the price today, I can see that I can get $1 of, what is it? It's what price we pay for $1 of earnings. So that means that I'm only paying $14.41 if I want to share in $1 of earnings. That's pretty cool. I mean, you figure you buy that, I mean, it's not too long before that thing's generating money. Now, again, people say, well, God, if it's only doing that, 12 months, that's 14 years before I get my money back. But you got to figure, what about growth? I mean, the forward PE, it's looking even, looking like it might even be better, which means they think they're going to earn some money. Okay, but don't be deceived. That's not a reason to hold off in buying the stock necessarily, because the price could be more expensive there. Think about it this way. Let's say you buy a house, and maybe I could even draw this. Let's say you buy a house, and the house costs $120,000. Okay, 120K here, and you get the rent, and let's say the rent is $2,000. So see, people will pay this price, this is the P, that will pay this price to receive E, this earnings, right? Well, if I pay this now, okay, maybe in the future I'm locked in. See, I paid $120. And maybe in the future it's making $5,000 a month in rent. See that? So people pay these prices now because they think their earnings might go up in the future. You follow? So just because it has a PE of 11 in the future, hey, you may want to buy it now. So that's the paying for earnings in the future. You look at forward PE, that's just expected. So you want to make sure, FYE, what does that stand for? Oh, fiscal year end. So it says, look, in the fiscal year ending September 25th, we think this will be the PE. Well, that's not a guarantee, is it? Things can happen. So anytime you look at something forward, that's what they think might happen. They think that's likely, but it's not guaranteed. PEG ratio, 5 years expected. This is pretty good. Remember Tanner Brothers at 61? That's pretty darn good, man. You know what that means? That means they're growing. That means this company's earnings have been growing and growing and growing and growing. And think about that. Apple, sure, their stock's gone up to $300 a share. And so you figure, when you pay $300 a share, you're paying $14 for every dollar in earnings. You're getting a lot of earnings at $300 a share. So what's been amazing really about Apple is, yeah, their price has exploded, but so have their earnings growth. They're selling iPods and iPhones and all kinds of stuff all around the world. So your PEG ratio is your price, but it also figures in your earnings and your growth. So it looks like they're growing. It looks like they got some really decent earnings and they're growing. 6:1. Killer PEG ratio. We'd want to compare that to others in the industry and others against the S&P 500, see how they're doing. Price. Notice these things. Price, okay, to sales. So in other words, they're having income here. They're selling stuff. That's not earnings. That's just the sales, right? This isn't taking in the expense. It's just the sales. So how many sales are you getting for what you're paying? You're only paying $3 to get a buck of sales. That's pretty impressive. Price to book. What's price to book mean? Well, price to book is this. Your book value. In other words, what's on the books? Well, that's what you're paying for your assets, right? That's what you're paying for your assets. Most recent quarter anyway. MRQ, most recent quarter. Okay, so price to sales, price to book, how much you're paying for the assets. Hey, enterprise value, this is another ratio, right? So in other words, we have this enterprise value as it relates to the revenue, again, the income. EBITDA, that sounds like something for my friend Tom Wilwright, Robert's CPA. How about this? Earnings before maybe interest, taxes, dividend, or depreciation and appreciation, something like that. That sounds good to me. So in other words, what's the enterprise value okay, according to the earnings. Not just the revenue, but also the earnings. Very fun stuff. So there's a wealth picking activity for you. Go look at your stocks. See how you compare against the S&P 500. See how you compare against other stocks that you could be owning. You might be not poised to grow as much as another. You might be paying more for a dollar's earnings than you think. So starting to learn a little bit about value, fundamental analysis, and the strength of an entity. Let's do a comparison. Here's P&G, Procter & Gamble. Large cap, both of them above 10 billion. Okay, but let's look at this right here. Let's look at the trailing PE at 14. And let's look over here at the trailing PE at 14. So I'm paying $14.89 for dollar earnings here. And over here I'm paying $14.41. Pretty much the same, right? 14 bucks for a buck of earnings. So this is $300 a share, right? P&G, they're probably somewhere in the 30s, 40s, $30, $40 a share. So what's the difference? How do I choose? How do I find what's valuable? Well, look at the PEG ratio here. This looks like this is poised to grow a lot more than this one's poised to grow. Do you follow? So if I'm looking for just price to earnings, it's pretty comparable. But here I'm paying $1.55 for those earnings and their growth. And here I'm only paying 61 for 61. Look at this, $1.55 for price earnings, right? Price earnings and growth. Well, here it's only 0.61. So over here, this is the growth company, isn't it? This is the growth company. Okay, but here's the other thing I've got to realize. Apple is a growth company, which means, yeah, I'm paying 14 bucks for a dollar of earnings. Problem is, I don't get any of that earnings. Why? Well, the board, the shareholders can vote for the board, the CFO, they're going to decide, hey, should we do a dividend? Should we actually give this money to the people who own the company? Or should we reinvest this for even more growth? Can we try to get ourselves even bigger and dominate more market share? It is technology, there's obsolescence risk. Maybe we better take our earnings and invest in research so we can make smaller iPads that are faster, that have longer battery life. And maybe we need to keep up with this, so we take all our profits and we invest in growth, which will make our stock price go up because we're more valuable, because we're getting even more earnings because we invested in growth. And so if a person wants growth, they're thinking, hey, I'm going to do this and buy Apple at 300 so I can sell it at 6, like Google or something. Of course, if a person wants dividends, hey, they'll pay a dividend at P&G. So over here, you're going to pay your 14 bucks for earnings that are going to be reinvested in for growth. A lot of people upset with Apple, they aren't paying it back. Well, don't be upset. Just learn to do fundamental analysis. If you want some money back, well, then buy P&G. $14 gets you dollar earnings. They're going to take some of that earnings, give it back to you. Go buy Verizon. They pay a dividend. So do you want growth? Do you want to try and buy the stock at 300 and sell it at 6? Or say, hey, look, I just want to buy P&G. I want to hold on to it for a while. It might not grow that much, but at least I'm getting paid each month. That's an important part of fundamental analysis. It's also an important part of cash flow. We're going to do a class on cash flow, but I get email all the time from people saying, should I buy silver? Should I buy gold? Should I buy stock? Should I buy Apple? Should I buy this? Well, you need to know what you want to buy before you buy it. You need to know what your goals are. So maybe we should talk about that for a minute.